Now, IND AS I have mentioned two differences. Effectively, these are the two differences. There is a third difference that is often being identified, which I don't consider as a difference at all. I'll tell you that third. From there, we'll move on to these two. One of the differences that is often, I'm just seeing too many articles on this one, wherein they say that you need not capitalize borrowing cost on inventories which are repetitively getting manufactured. We saw that specific clause even under AS number 16. The IND AS 23 la scopely exclude பண்ணிருக்காங்க. That's the difference. Now, you can't call that as a point of difference. If something is presented somewhere else and something is presented as part of scope era, now how big a difference is that one? I don't understand, but I do find like too many, books and articles highlighting that as a difference. Inventories manufactured on repetitive basis in a short period of time in large quantities cannot be qualifying asset. I think that's there even an existing standard. Other பெரிய point does not discuss. The one that we require to understand is something about assets measured at fair value. ஒரு direct example, IND AS does have an accounting standard for biological assets. In fact, I'll just show you separate accounting standard. Okay. Agriculture, sorry. Separate accounting standards for agriculture. We guys know when we were doing our intermediate, we had something called as farm accounting. In the syllabus, we had something called as farm accounting and all, which in spirit is getting replicated even now in your what you call as agriculture. Chinna example. How do you, or example, somebody has got a what you call as milk cooperative society mari or entity or something can be limited liability company. Their major asset is only your farm animals. No doubt at all about that one. அப்போ அவங்க அசெட்ல அனிமல்ஸ் தான் காட்டணும். அனிமலுக்கு என்ன கேரிங் அமௌண்ட் இருக்கும்? No, they may not always acquire. Most of the farm animals could have been bred internally. What would be the cost? நான் சொல்ற பாயிண்ட் புரியுது. When you're acquiring something, it is pretty easy to find out. What you're having is something that gets like multiplied, not because you're incurring some cost. So in the மாதிரி scenario, your logic says that you should show them as your asset, but there is no cost. What will you do? So these assets are carried at fair value. இப்போ மொத்தத்தில் வந்து 10 மாடு வாங்கினேன், now it has become 100. You will find that you are carrying that like 100 cattle at fair value, not at cost. You may not be able to measure cost. So all these items are measured at fair value. அப்போ fair value measurement is mandated for biological assets in terms of IND AS number 41. Now, அப்போ question என்ன? What would be the case where I might be spending some money in acquiring the asset? First 10 மாடு நான் காசு கொடுத்து வாங்கினேன். I would have borrowed money to buy those assets also. Banks are lending me money, government is giving me incentives, whatever. I'm incurring borrowing cost, but the asset is such that I have to carry them at fair value. But when the asset is carried at fair value, would I be required to capitalize borrowing cost? Does it make any sense? I am capitalizing borrowing cost because these are costs incurred to acquire an asset, develop an asset, construct an asset. Pandroma, when asset itself is carried only at fair value, you'll find there is an internal conflict, inherent conflict between debiting cost incurred to an asset which is carried at fair value. Visualize பண்ண முடியறதா? Carrying amount should be fair value. How can I debit cost? Finished. So on the cases, they say that in general, borrowing cost cannot be, should not be capitalized for those assets which are carried at ஒரு specific clause கொடுத்திருக்கேன். That specific clause you don't have under existing accounting standard number 16. Why? Presently we don't have fair value concept also. Are you clear about this, guys? நிறைய இருக்கு. When we look at something about IND AS 41 on agriculture, I'll tell you bearer plants na enna, what is not treated as bearer plants, fish க்கு எப்படி account பண்ணணும், what you breed, what you buy, lot of things. We'll look at all those kind of ideas sometimes separately. So இது ஒரு major point. So என்ன major point number 1? IND AS 23 specifically states that borrowing cost cannot be capitalized on assets carried at or measured at fair value. Logic ரொம்ப simple. That's an inherent conflict. You cannot capitalize the cost for an asset which is carried at fair value. ஞாபகம் வச்சுக்கோங்க. Standard examples are all about agricultural assets, including your so-called farm animals or your plantations, so farms, fruit orchards, என்னென்னமோ இருக்கு. இப்போ in today's context is, tomorrow's context, they are qualifying assets. In fact, IND AS 23 they go about saying that qualifying assets will include and solid bearer plans கொடுத்திருப்பாங்க. Right? In today's context, they are not. They may not appear tomorrow. So clear, guys? This is like one major idea, which implies if at all there is a borrowing towards an asset, you are incurring the expense of completing. Second is a concept of effective interest rate. I will say that this is not exclusive to IND AS 23. Even in today's context, we end up using this concept of effective interest rate. Somewhere, I'm not sure whether you had an opportunity to see one such idea, but effective interest rate is a very popular accounting idea even today. Earlier, we were discussing something about zero coupon bond. Have you seen any of the companies having zero coupon bond here or a deep discount bond? Anybody? Anybody who has seen or audited some trust funds and all? Not every trust fund follows this. Some trust funds which acquires bonds. PF trust audit பார்த்திருப்பீங்க, gratuity first trust audit. Some of you, nobody has done that one. You will actually know when you get a chance, or at least Google around, ask some of your friends who have done that one. And not everyone follows this accounting. The first time we recommended that, the finance head was like looking at me, why are you suggesting all these things? They can't even understand it. CPC trust. So this company, I mean, these trust funds have long-term debt. They invest. They are not supposed to be like very adventurous and go about investing in equity. Now some permissions are granted. Earlier they were not. EPF first trust fund, these guys are collecting money from the employees and employers. Funds are accumulated, mass for 40 crores probably. These are getting deposited where? Bonds. AA rated, AAA rated, all these kind of bonds. Bonds are traded in the market. Not every day somebody will issue a bond. Every day you will find that bonds are traded in the market and you might be buying a bond which is already traded. Possible, for 5 lakh rupee face value bond, I will buy like 20 bonds, 2 crores, something. I will buy all these kind of bonds. The open market price will be different. 1 crore face value, you might be probably buying it for 98 lakhs. Or you might be buying it for 103 lakhs. Correct? But at the end of the period, end of the bond holding period, you will be getting 20 rupees face value. So 103, every 100 correct the books. These guys are generally right now, amortizing it in time proportion basis, which is not right. So, you can amortize it based on something called as effective interest rate method. So, what is an effective interest rate? The idea is very simple. When let's say that we are issuing a loan, raising a loan, face value 100 lakhs, debenture, we are issuing them at a discount of 10%. The issue proceeds will be only rupees 90 lakhs. What is the present accounting model? You will carry the loan liability at 100 lakhs. Discount expense 10 lakhs and taniya kaatuvom, which is getting amortized. Now, whatever we are doing will be replaced by a financial instrument based standard, which will be seen as part of module D, wherein they say, carrying amount of liability itself should be only rupees 90 lakhs. You cannot have that as 110 separately. Net 90 mottum kaatu. What's your interest rate? 10%. But 10% is on face value. 100 lakh 10% is 10 lakhs. They say the interest rate. Your effective interest rate is something else. Every year you are going to pay 10 lakhs on 90 lakhs probably, and therefore on 11% is your interest rate. We call it as effective interest rate. Simpler internal rate of return madri. That is what we will be using. So IND AS number 23 states that borrowing cost should be measured not based on nominal interest rate, that is declared coupon rate or interest rate, but based on the implied interest rate, also known as the effective interest rate. I'll just give you an example. Effective interest rate is not the declared rate. Effective interest rate is nothing but is equivalent to what here? The implied interest rate measured using your typical IRR approach, whereby present value of all future loan outflows, including principal and interest, is equal to what? Carrying amount of SFM budgeting layer. Anybody who's already done your SFM? Anybody? Nobody. There is a concept called as yield to maturity in bond. Bond or segment will come across something called as yield to maturity. That's an example of effective interest rate. Your coupon rate in that will be different. Your effective interest rate or YTM will be different. I'll just show something and then we'll. Some bond will select. Yeah. Look at this here. This is a very small example. In the bond, Rural Electrification Corporation Limited, the bond, RECL bond for capital gain and all. Capital gain, 54 ECA, what is that? Something. Say a face value 1,000 rupees. Their coupon rate is 8.71. That is what RECL will pay. But today's market price is 1,270. So they will say that if today I am going to buy this bond or borrow or whatever, short sell something, 1,270 is what I will be receiving or I will be paying as appropriate. Other maturity period still 24th of September 2028. So implied interest rate YTM 5.5504%. In the rate this is what we call it as effective interest rate. Supposing if you are acquiring this instrument today, you will not be recognizing interest income at 8.71%. You will be recognizing interest income only at 5.51%. Follow up. If supposing you are issuing this bond, face value 100, interest rate 8.71, you can raise 1,271. Premium and issue in your borrowing cost account, P&L account or borrowing cost account, you will not debit interest cost based on 8.71, but rather only based on 5.55. A simple example, equate effective interest rate to something called as yield to maturity. Just Congo. At later point of time when you actually learn those ideas under SFM, try to relate these two ideas. These are overlapping ideas. What you learn there, you can apply it here. What you learn here, you can apply it there. Rendu ore concept da. Anga formula kuduthirpaanga, formula odukkichukonga, concept try to take it. Don't look at that as some kind of mathematical approach to get a number. Look at the idea. Effective interest rate is nothing but implied interest rate. Ennathana discount all future cash flows at 5.55%, you will get 1270. That's all. Guys. So they say that you don't recognize or measure borrowing cost based on 8.71%. Do it based on 5.55. 5.55 is the effective interest rate. A zero coupon bond interest rate is it not here? But still there is a borrowing cost. Difference between issue price and maturity process. They say issue price you maturity compare panni, figure out an implied interest rate. On the rate la quantify what is borrowing cost. So we will see this idea in detail. In fact, our full class will be speaking only on the concept of effective interest rate when we handle financial instruments. Sadharana idea, but to register. For the time being, just mention this. For the sake of reference, I'm just mentioning that effective interest rate discussion on the will be in N0109 financial instruments, module D, effective interest rate is equivalent to yield to maturity in SFM bond chapter. Both are one and the same. Underlying logic one is what you need to keep in mind. So in enna solra, you go only by effective interest rate, you don't go by nominal rate. Nominal rate is what is declared rate. 8.71 is referred to as nominal rate. 5.55 is referred to as effective interest rate or YT, so to speak. So you use that to compute your borrowing cost, which is not the case today. Chariya, of course, this is like follow-out of IND AS. The preference dividends can become borrowing cost. Will become. So no more dividends, no more treatment as appropriation of profits. Even though your taxation laws might be treating it differently, your accounting demands that you treat them only on par with borrowing cost. Chariya, preference dividends we will be calling them only as borrowing cost. Are you clear, guys? When you are required to, I am not sure whether you applied this or not, delayed payment of advance tax category interest. You are supposed to include that as part of borrowing cost. That's what your guidance is all about. So yeah, get to know that. The taxation la expense of a treatment, we don't care. It is still to be treated only as part of your borrowing cost. This got nothing to do with IND AS. Even today, the interest on delayed payment of taxes is considered only under borrowing cost. Now, logic is any interest bearing liability. If you don't pay, you are going to pay some amount of cost, treat that as borrowing cost, and therefore included in your financing cost. Taxation category borrowing cost you can never capitalize. That's a given. But extra the point I just wanted to emphasize here was don't bother too much about what the taxation law says. That cannot influence your accounting. Or the tani, idu tani. You just learn to differentiate these two things around. Done, guys.